Most people assume the hardest part of retiring is accumulating enough. It isn't. The hardest part is keeping what you built once you stop working. Here's the pattern that plays out constantly. You grind for 3 decades. You hit your target number. You walk out the door. And then you spend the following decade watching your balance tick downward, telling yourself it's temporary. The market recovers. The 4% rule is solid. The research says so. And then the recovery takes longer than expected. And suddenly you're 73, and the options available to you look very different from the ones you had at 63. That's sequence of returns risk. And in 2026, with the S&P 500 priced at levels that have prompted voices like Howard Marks and Ray Dalio to openly discuss the possibility of a lost decade ahead. That risk isn't a textbook concept. It's a live threat. So, today I'm going to break down the 3 retirement income strategies most people are actually using right now, explain precisely why 2 of them are built on shaky ground in this environment, and show you the one framework I genuinely believe in, not because it's flawless, but because it doesn't require the market to cooperate on your timeline. Think of every retirement strategy as a machine. I'll keep returning to that image because it captures what matters. Every machine works under ideal conditions. The real test is what happens when conditions stop being ideal, when the power cuts out. Does it keep running? Let's examine the most widely used machine first, the index fund combined with the 4% withdrawal rule. Stack your savings into something like a low-cost S&P 500 fund. Stop working. Pull out 4% each year. That's the whole plan. Clean, simple, grounded in decades of research, specifically the Trinity study, published in 1994, which analysed rolling historical periods and determined that a 4% annual withdrawal had a very high probability of lasting 30 years. Compelling work. Except that study was built on return assumptions from a completely different valuation environment. The S&P 500's cyclically adjusted price-to-earnings ratio, the CAPE ratio, currently sits at levels that have historically produced roughly 0 real returns over the subsequent decade. JP Morgan has published analysis on this. This isn't a niche argument. When you're buying expensive assets and then immediately liquidating portions of them to pay your bills, the arithmetic turns ugly quickly. Here's a concrete example. A Japanese investor will call Kenji retired in January 1990 with a solid portfolio and a reasonable withdrawal plan. Index funds, the standard approach. The Nikkei was hovering around 39,000. He assumed the trajectory would continue. It didn't. The Nikkei didn't reclaim that level until 2024, 34 years later. Kenji didn't have 34 years. You might say that's Japan, a unique situation. And you'd be partially right. Different demographics, different monetary policy. But the underlying mechanism is identical. You enter retirement at peak valuations. Markets go sideways or drop. You're forced to sell shares at suppressed prices to cover living expenses. Every forced sale permanently reduces the number of shares participating in any future recovery. That's the machine breaking under load. Here's a number worth sitting with. Retire with $1 million. Market falls 40% in year 1, which happened in both 2001 and 2008. You're now working with $600,000. To maintain your original dollar withdrawal amount, you're no longer pulling 4%. You're pulling closer to 6.7%. Your lifestyle hasn't changed. The math has changed it for you. The 4% machine needs favorable weather to function. The current forecast is not favorable. Now let's look at the second machine, what some people call the income factory. This approach has gained significant traction recently. The logic is straightforward. Rather than selling shares to fund retirement, you build a portfolio of high-yielding instruments, covered call ETFs, collateralized loan obligations, leveraged closed-end funds, and live entirely off the distributions. Yield pays the bills. Principal stays intact. Mechanical. Predictable. Safe feeling. The appeal is real. It resembles owning a rental property that deposits money into your account monthly with no tenant calls. Except many of these instruments are the financial equivalent of a stunning home built on a floodplain, gorgeous in dry weather. one serious storm away from catastrophe. Take covered call ETFs, posting 15 to 20% yields right now. They've looked outstanding because we've been inside one of the most powerful bull runs in modern history. The majority of these funds launched after 2020. They have never encountered a genuine prolonged bear market, not a 6-week sell-off followed by a sharp V-shaped recovery. A real grinding 18-month decline with no quick rebound. When sustained volatility arrives, covered call structures begin returning your own capital disguised as a ticket. Your principal erodes. Your yield erodes with it. You're not collecting rent. You're quietly dismantling the building to pay the heating bill. Leveraged closed-end funds present their own version of this problem. Some carry jaw-dropping yields, 8, 10, 12%, backed by pools of high-yield debt, amplified with borrowed money. Picture a convenience store owner borrowing at 5% to purchase inventory he sells at 10%. A perfectly sound business, until the supply chain fractures, inventory values fall, and the bank calls the loan. He's suddenly forced to liquidate his best inventory at the worst possible prices just to remain solvent. That is precisely what unfolded with certain leveraged MLP funds during the March 2020 collapse. Not because the underlying companies were struggling. Many had investment-grade balance sheets and kept operating without interruption. But the leveraged wrappers holding them faced margin calls and forced liquidations at the exact bottom. Some of those funds never recovered. Some shut down entirely. Here's what's worth acknowledging. The income factory crowd isn't wrong about the fundamental concept. Generating cash flow in retirement beats liquidating shares. The idea is sound. Many of the execution vehicles are not. So what does the third machine look like? Consider a retired teacher. Call her Barbara. No financial advisor. Just a yellow legal pad and one self-imposed rule. She would only hold income from companies that had raised their dividend for at least 10 consecutive years, maintained a debt load she could verify, and operated businesses people depended on regardless of economic conditions, utilities, pipelines, real estate with long-term leases, business development companies with proven underwriting track records through multiple credit cycles. Was her yield impressive? No, it was solid. Around 6 to 7% blended. Did it keep pace with inflation? Yes, because dividend growth was a non-negotiable ownership requirement. Did it survive every market downturn she encountered? Yes, because the income kept arriving even as prices fell. She never needed to sell anything. That's the third machine. And in 2026, it's the one I trust. Here's the framework. I call it the two-pile system. The first pile is your foundation layer, diversified, lower volatility, dividend, growing assets that form the primary income engine. The second pile is your yield enhancement layer, a smaller allocation to higher yielding instruments that add cash flow without threatening the whole structure if one position has a rough year. The foundation layer needs to do 3 things. First, produce a dividend yield that covers or nearly covers your core living expenses. Second, grow that dividend at a pace that outpaces inflation. Call it 3 to 5% annually. Third, be backed by businesses with durable defensive models that generate real cash regardless of economic conditions. Think midstream energy infrastructure, pipelines that collect fees based on volume, not commodity prices, with investment-grade balance sheets and distribution growth written into the contracts. Think triple net lease real estate, where tenants absorb operating expenses and you collect rent with contractual annual escalators. Think regulated utilities with long-term power purchase agreements, especially relevant now that AI data center demand has transformed electricity into something resembling a growth industry. Think business development companies that have demonstrated the ability to underwrite credit risk through multiple cycles, not just the easy ones. Schwab's U.S. Dividend Equity (ESTF) serves as a reasonable anchor for the foundation layer. Expense ratio of roughly 0.06%, approximately 4% yield. A 10-year track record of growing that dividend at over 10% annually. Exposure to more than 100 blue-chip dividend payers across sectors. Not exciting. Reliably functional. Think of it as the concrete slab before anything else gets built. Layer infrastructure and utility exposure on top of that. Add some mega-cap tech participation through a thoughtfully constructed covered call ETF. not as a core position, but as a complement. Something like GPIQ from Goldman Sachs, which uses a dynamic hedging approach that captures more upside in rising markets than static covered call structures. Here's a practical illustration. You're 58 years old. You have $1,200,000 to deploy. You need approximately $7,000 per month in passive income, $84,000 annually. That requires a blended portfolio yield of around 7%. One possible allocation? 30% in SCHD. $360,000 at 4% yields $14,400 annually. 15% in a utility-focused closed-end fund. $180,000 at 6.5% yields $11,700. 10% in GPIQ. $120,000 at 10% yields $12,000. 20% across 3 or 4 quality midstream companies. $240,000 at an average 7% yields $16,800. 15% across 2 or 3 triple net REITs. $180,000 at 5% yields $9,000. 10% in 2 or 3 BDCs. $120,000 at 9% yields $10,800. Total annual income, roughly $74,700. Blended yield, approximately 6.2%, not quite the $7,000 monthly target. But with dividend growth embedded across most of these positions, you realistically reach that number within 2 to 3 years without contributing a single additional dollar. And critically, none of this requires the market to move higher. The machine isn't self-maintaining. You need to monitor whether dividends remain covered by actual underlying cash flows. A midstream company accumulating excessive debt is a problem. A BDC issuing new shares at a discount to NAV to fund loan origination is a warning signal. A REIT overpaying for acquisitions today becomes your headache in 3 years. This is not a set-it-and-forget-it approach. Someone will tell you to just buy the total market and let it compound. And I've thought seriously about that argument. I've also thought seriously about what happens when the market delivers flat returns for a decade while you're liquidating shares throughout. The math on that scenario is uncomfortable. Yes, this requires more active engagement than owning a single ETF. But consider the alternative: running out of capital at 71 and trying to re-enter a job market you left a decade earlier. That requires considerably more work. Here's the insight most people miss entirely. You think the primary challenge in retirement income is locating assets with sufficient yield. It isn't. The real challenge is durability. High yield is abundant. Scroll any financial website and you'll find funds paying 15 to 20%. The question was never whether yield exists. The question is whether your income machine is still running in year 8, when the economy has been contracting for 18 months and your portfolio is down 30% and your sequence of returns has been genuinely bad. That's where the quality of the underlying businesses determines everything. Enterprise Products Partners has raised its distribution for over 25 consecutive years, through 2008, through the oil crash of 2015, through the COVID collapse of 2020. Not from luck, because their fee-based pipeline contract structure is architecturally insulated from commodity price movements. Revenue flows when gas moves through the pipe. Gas moves through the pipe when people heat homes and run power plants. People always heat homes and run power plants. That is an income machine built for bad weather. What the vast majority of people do wrong is one of 2 things: reach for unsustainable yield in instruments they don't genuinely understand, or cling to the 4% rule applied to an overvalued index because a 1994 academic paper told them it was safe. Neither of those is a real plan. Their hope translated into spreadsheet format. Which brings us back to the beginning. The hard part was never accumulating the money. The hard part is not watching it disappear after you stop working. And the way you protect it isn't by chasing the highest yield you can find. It's by constructing a machine with multiple components across different sectors and different income structures, where if any single piece underperforms in a given year, the remaining pieces continue paying you while you wait for it to stabilize. 3 concrete steps for this week. First, Stress test your current retirement income plan specifically for sequence of returns exposure. If your plan depends on positive market returns in the first 5 years of retirement, that's not risk management. It's optimism wearing a spreadsheet as a costume. Second, map your income sources to sectors. If more than 30% of your retirement cash flow comes from a single sector, say technology-adjacent covered call funds, you have concentration risk disguised as diversification. Genuine diversification means pipelines, real estate, business credit, and infrastructure operating in the same portfolio with genuinely different economic stress triggers. Third, require dividend growth as a non-negotiable condition of ownership. A static 7% yield that doesn't grow is worth less over time than a 5% yield growing at 5% annually. A decade from now, the growing one has outpaced inflation. The flat one has been quietly eroded by it. The market may have an exceptional year in 2026, I genuinely hope it does. But your retirement income strategy shouldn't be contingent on that hope. Build a machine that runs when it's raining,